folks, everyone. Boy, do I have a show for you today. I'm going to show you 10 charts that prove and predict the greatest crash of yours and my lifetime could be just months away. We've got a wealth of information. What's really going on out there in the economy? What's really happening in the financial markets? And this is something you're definitely not going to want to miss because there is so much happening. There is so much uncertainty. There's so much fog and cloud. Nobody knows, or apparently nobody on Wall Street knows what's going to happen, but we have some huge insights. I'm going to go from the first chart all the way to the last few charts, which are very important, and I'm going to bring this macro picture all together to break it down in very simple terms so everyone can understand what is really going to happen. Because never in modern history have we been at a point where there are so many multiple crises hitting us at once. We have global conflicts breaking out. We have geopolitical tensions at boiling point. We have stock prices that are still at record highs and are severely overvalued. We have a housing market that is the biggest housing bubble in history, right when interest rates are going to record highs. We have crisis after crisis that is about to collide to create a huge cataclysm. So everyone, without further ado, you know what time it is. Let's get straight into the news, the facts, and the data. So first things first, what we need to talk about, what's going to be the tipping point is when the unemployment rate finally starts to go up. And people, we're seeing layoffs after layoffs are starting to be announced. Ford to lay off another 550 workers after the UAW surprise move hits Kentucky truck plant. But not just that. LinkedIn owned Microsoft lays off nearly 700 employees, and there's a memo here. But look at this. I have there's a list here of the amount of companies that have announced layoffs in 2023 alone, and watch how big and how long this list is going. Now, I can't possibly say every single name, but you can pause the video and have a look here. Look at the massive list of companies that are beginning to announce layoffs. And again, what's going to be, the catalyst to really kick things off will be when the official unemployment rate, starts to tick up. But again, what are these 10 charts that I've got to show you that something big is happening? Well, again, everyone, let's go to the first and to the 10th. You're going to need to watch all of these charts. So first things first, the reason why we haven't seen a crash yet is because this has been the fastest rate hike cycle in US history. So what does that mean? Well, that means unlike other crashes throughout history, as we can see here in 99 to 2000, 94 to 95, 89 to 88 to 89, and 04 to 06, there was much more time for these interest rate hikes to flow out into the economy. But again, because interest rates have gone up by 5% so quick, we haven't felt the lag effects, which I'll get into a moment, which will absolutely blow your brain. Okay, next. Who is predicting a recession on Wall Street, or who is predicting a recession at the Federal Reserve? Well, look at this. This shows how much credibility the Federal Reserve has. Only 0%, nobody at the Federal Reserve is saying there's going to be a recession in 2024. That is a complete joke. And that tells you why we should not pay attention to what they say, but what they do and where the big money is going. Now look at this. The yield curve predicts a 61% chance that there'll be a recession. Economists, 48% of them say there'll be a recession. Now this is you guys, consumers, 69%. This is Main Street. These are the people that really know what's going on out there in the economy, because a lot of the people at the Federal Reserve, they're completely out of touch. They don't know what's going on out there. They've got their multi-million-dollar salaries. Inflation doesn't bother them. Okay. The bond market, that is signaling something very distressing. And we got huge news, which is going to affect the bond market massively that I'll get into later in the video. But like I said, you guys that speak to your neighbors, that see what's going on out there in the real world, because remember, by the time Wall Street figures out what's going on out there in the real world, they won't get the data till 6 months later. But if you go out there and speak to people, if you speak to your family, if you speak to your friends, they're saying the cost of living is absolutely crippling them. but the people on Wall Street are out of touch. Now, Goldman Sachs says 15% chance, Bank of America, much bigger chance. But who is actually the biggest? And who is probably the most credible? Okay, I'd probably say you guys and CEOs. 84% of CEOs say there's going to be a recession and a crash in 2024. Now, I'm going to show you a very, very important chart why CEOs know a crash is coming in 2024, and it's going to absolutely shock you. Now, I know what you think. Well, Michael, you've been calling for a crash. There's been no stock market crash. Why exactly is that, everyone? Well, that's this chart here. That's the Magnificent Seven. Now, what is the Magnificent Seven? Well, that's Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. Now, why is this so important? I'll move myself here so you can see this a bit better. Is because they make up 28% of the S&P 500. So just these 7 stocks can significantly impact what happens to the S&P 500. So what has happened to these stocks over the past year? Well, look at this, everyone. Meta has gone up 150%, Nvidia 200%, Apple 35%, Microsoft 34%, Alphabet 53%, Amazon 50%, Tesla 111%. Now again, why is this so important? Well, if these 7 stocks that are severely overvalued, if they tank, is going to bring down the whole S&P index as well as the NASDAQ. Okay? Now, so that's what's happening on Wall Street with the data statistics. We got another report that's showing that this is unsustainable. What's really going on out there? Look at this. I'll go ahead and move this here. Credit card debt is as high it's been in the history of the United States, according to the Federal Reserve. And that is absolutely true. Credit card debt is now over $1 trillion. And again, I'm going to show you a report that just came out today, which shows this is completely unsustainable. And if people all of a sudden max out their credit cards when interest rates are at peak, they're simply not going to be able to spend anymore. We're going to see a spending collapse and companies' revenue collapsing, which again will tie into another chart I'll show you in a moment. Because look at this other chart here, which I'll go ahead and move myself so you can see better. Credit card interest rates. Again, we haven't seen credit card interest rates, which is the black line here, over 20%, and the orange line here is a 5-year US Treasury. Credit card rates have just hit their highest levels. The average credit card rate is now over 20%. Now, I don't know about you. I don't think you have to be an economist to figure out that if credit card debt is at its highest it's been in history, when at the same time interest on that debt is as high as it's been in history, this can't keep on going on forever, and it's going to cause something to blow up in the financial system. Now, this is what I want to show you, everyone. The reason why all CEOs are predicting a recession in 2024, I'll move myself so you can see it's better here, okay, is because of this. Corporate debt maturing. Again, this could lead to a financial crisis as well, just like the banking crisis. So as we can see here, there's about 500 to 600 billion that will be maturing in 2023. But look what happens over the next 2 years. In 2024, $800 billion of corporate debt will be maturing. Now, you're probably wondering, well, what does that mean? What happened during COVID in 2020 and 2021 when interest rates at the Federal Reserve would drop to zero? A lot of corporations could go ahead and buy debt, or they could go ahead and get a loan, and they could get a loan at 2 to 3%, and then they'll go ahead and reinvest in their own corporate bonds, which were paying 5 to 6%. And what normally happens is they may get an adjustable rate. Most of these are adjustable rate loans. So after 2 to 3 years, instead of having to pay 3%, which a lot of these, what they're called zombie corporations, meaning they can only survive if interest rates on their debt don't go up, we're going to see trillions of dollars over the next year or two go from an interest rate of 3% to 8%. Which again, I'll bring the chart back up. We can see in 2025, over $1 trillion of corporate debt will be maturing, and these companies, a lot of these zombie corporations, they're not going to be able to afford to repay these people, and it's going to lead to a lot of bankruptcies, which is what we're already seeing right now. But what is the biggest corporation of all in the United States? What is the most powerful institution that will have the biggest effect on the markets and the economy? Well, good if you'll guess it, everyone. It's the US government. Look at this. When I saw this chart, it summarizes perfectly what is happening to the United States, the great empire that if they don't make drastic changes quick, will crumble. Okay? Look at this. I'll move myself again so you can see this. Cumulative growth rates of debt, GDP, tax, and revenue. So what we can see here, the blue line is interest expenses, the orange line is the US GDP, and the green line is tax revenue. But what is this red line that's absolutely skyrocketing? That is federal debt. So we can see here in the 80s to the early 90s, it was pretty similar. The interest expenses were pretty similar. GDP was pretty similar to the debt, and tax revenue was pretty similar as well. But what we can see here, since 2000, we've seen a great divergence in this line, and the US federal government debt has gone up out of control when at the same time, GDP is not keeping up and tax revenue is not keeping up. Again, people, the US government is spending like, an 18-year-old girl that just got her first credit card and that lives with her parents in their basement and has no responsibilities at all. I just want to reiterate, this is unsustainable and it cannot keep on going on. So what's either going to happen is we're going to see record inflation, and also, what's going to pay for this difference here between the green, the tax revenue, and the debt? That's right. You better believe it. Your taxes are about to skyrocket. So that brings us to our next chart, everyone, which when the federal debt is skyrocketing so high, at the same time, interest rates are going up at the fastest pace in history, well, what will that lead to? Well, you know what's about to be one of the biggest expenses for the US government? Just the interest. Not repaying the debt, just the interest. Look at this next chart here, everyone. Federal interest expense. We can see here, in the 80s, again, it was only around 200 billion, which was still pretty high. But what we saw in 2020 was something absolutely ludicrous happened. The interest expense from 2020 to 2024 is going to double. It's going to go from 600 billion in 2022, should I say, to 1.2 trillion next year in 2024. People, again, this is unsustainable. It can't keep on going on like this forever. And again, this leads you to my last two charts, which are very, very important. Or again, why hasn't the crash happened? Well, we have to go back at history to figure out what happened when the Federal Reserve lifted interest rates and when did the recession really hit? Well, this is the Fed funds lag effect. What we can look at is when interest rates hit their peak, not when they started lifting interest rates, when interest rates hit their peak, okay, which we're still not at the peak in this rate hike cycle, okay, in 1989, it took 15 months for the recession to happen in 1991. In 2001, when interest rates hit their peak, again, their peak, not from when they started lifting them, okay, 8 months later, we had the recession. Now, the biggest financial crisis and the Great Recession that we had, it took 17 months after interest rates hit their peak till we saw the financial crisis of 2009. And then we saw recently, 2019, it happened 10 months later. So what this tells us, when we look at the average, it's about 11 months after interest rates hit their peak before we start to see the real consequences for the economy. And people, we just got a new report today that shows we may not be at the peak of the interest rate hike cycle, which means all that debt that these corporations are in, all the debt that consumers are in with credit cards, all the debt that the government is in is about to get much more expensive. Because I'll go ahead and bring up this report here. I'll go ahead and adjust myself here and adjust that so you can see it. US retail sales top forecast in sign of durable consumer demand. Now, this may seem like a good thing. Consumers are spending. But for interest rates, this is very, very bad, because this wasn't just a big miss to the upside for retail sales. It absolutely smashed expectations. And that tells you all these economists at the Federal Reserve are completely incompetent. Okay? So what actually happened is the value of retail purchases adjusted for inflation increased 0.7% after an upwardly revised 0.8% gain in August. So again, not only do they get it wrong with these forecasts, but then they have to go ahead and revise these as well. The Commerce Department of data showed Tuesday, excluding gasoline, September sales advanced 0.7%. Now, why this is so bad for interest rates is because the Federal Reserve wants to bring the economy down. They want to cool things down. Now, if people are still spending, and again, the only reason why retail sales are going up is because not because people are going out there and spending like crazy, it's because things are going up 8 to 1% every month. They're not going up 0.4% like the CP lie data is saying. Prices are going up on average, okay, when you average it over a 1 year period, like we see with food prices, everything, they're going up about 1% per month. So this shows us that inflation is still at record highs and we are not at the peak of interest rates for this rate hike cycle, okay? So what can we do about this? Well, everyone, like I said, a big crash will be coming, so you're going to need to protect yourself. Now, what's been a safe haven throughout history, like I always talk about, is gold and silver. So you have some gold and silver, okay, when things really hit the fan, people will flood into gold and silver, and I expect gold and silver to skyrocket. Also, of course, if you're one of those people that are in that crazy high credit card debt with 20%, 10%, even 10%, go ahead and pay off that debt as fast as you can. The next thing is going to be very, very hard, but you need to get either a side hustle or a second job. I'd actually prefer to get a side hustle that one day you could turn into a business, because really the only way you're going to get ahead is not in the 9 to 5 people. Wages aren't keeping up with inflation. You have to become the CEO of the company and you can call the shots. You need to find another source of income. You can't rely on your job, because even though unemployment is at record lows right now, I don't think it's going to stay like that for much longer. You need to pay off that debt, additional source of income. You need to be in safe haven assets like gold and silver, maybe speculate into Bitcoin after we figure out what the Federal Reserve is going to do. If they don't hike at their next meeting, what that tells me, the tiny bit of credibility the Federal Reserve has left is gone. And they're not going to lift interest rates to fight inflation. They're going to let inflation rip, and we could see borderline hyperinflation, which again is bullish for gold and silver. So what do you all think about all this, everyone? Thanks for watching. You're awesome. I'll see you all in the next video.